So, again, greetings. Welcome to class. Um, Today, we're going to talk about insurance, and this is going to be a qualitatively different kind of lecture than before because I know enough about insurance to be dangerous, but I don't consider myself an expert. So, I'm going to um, go through, you actually use the textbook for the first time, chapter 9, right? Because, in the past, when I've given the lectures, I've just kind of talked about what I thought was important on that subject matter. Um, for this one, this lecture, I'm going to use the textbook as my guide, um, if that's all right with you guys. So, and before we jump into insurance, I wanted to let you know that the the last class on Tuesday, similar class as this, but different students. Um, After class, one of the students showed me how to upload videos to YouTube. So now the two investment lectures that we had um, are now available on Canvas for those of you who missed it. Um, and the links are available, shall I say, at the bottom of chapter 8 of the textbook in the modules. There's a YouTube link that you can click and it takes you to YouTube videos and you can see the lectures. And I saw lecture 1 myself, and not a pretty sight. I don't know. You kind of have an image of yourself. And then you get sorely disappointed when you see how your actual performance is on video. So it's 2 hours and it's got some good stuff in it, but taking me an awful long time to make that point, and I hope this is not another example of that. But anyway, if you've missed it or didn't capture something last time, the whole lecture, all 2 hours worth, both times, is not abridged in with all the ums and ahs and etc. It's all uploaded. So before I go into and start the insurance, are there any questions that you'd like me to answer? So, all right, cool. We'll keep going then, right? So I'm gonna share screen. I'm now gonna go to Canvas. So I'm in Canvas and I'm looking at, I wanted to look at chapter 9. So they're at the, here's chapter 8, right? Investments. Class, can you see this screen when I'm talking about it? Can you see it?
Yes.
Okay, thank you for that confirmation. So there's
Yeah.
chapter 8. I appreciate that. And then at the bottom of chapter 8 is investment lecture number 1 and investment lecture number 2. So those have the links to the YouTube. So if you wanted to see those lectures, again, 2-hour lectures each, right? Our typical class time, that's where you can see that. So chapter 9 is what I want to look at now. Bear with me while it's loading. So again, this one, I'm just going to, unlike my other lectures, I'm just going to heavily rely on this chapter to guide our conversation or discussion or the lecture. So this is about insurance in general and all kinds of insurance. And I think I'm just going to start with health insurance, if that's okay with you guys as a starting point.
Sure.
All right. So insurance companies are there to make money. It's like any other for-profit business. It's not a nonprofit organization. It's not a government social service program. It's private insurance companies providing services at a fee, and they want to collect more than in aggregate they pay out. So insurance basically covers a risk, a financial risk to you, which if you didn't have insurance coverage and had to pay for it yourself, that would be disastrous to your financial health, right? So it provides you protection against
Professor.
Yeah.
I'm sorry to interrupt you. Someone in the chat has a question regarding the monetization lecture video. Yeah, sorry
Okay.
to interrupt
Sorry,
you.
hold on. I can't see the questions when I'm share screening, so let me get out. Are you talking about the chat? Chat.
Yes, the chat. I think his mic is not working, so.
Can someone ask him to take a look at the question I posted in the chat? So what question is that? I have a question, but my mic wasn't working. Have you posted the amortization lecture video yet? Oh, okay. I have not yet, because I just figured out how to post the lectures, but I will. I have an amortization lecture, absolutely, videoed, and I will post that. I may do it tonight if I'm not too wiped out. Otherwise, it'll be done this weekend. Connor, does that help? Oh, you can't say because your mic isn't working. Any other questions I missed? And then if you have any questions, of course, about amortization, I'm available after class if you want one-on-one response. Okay, I'm going to close the chat window. Fair? So thanks for interrupting. Didn't really interrupt. Appreciate you drawing my attention. And now let me go back to the lecture. Okay, so insurance covers you for risks, provides protection so that in the event a disaster happens to you, it won't financially wipe you out, right? But in order to have that protection, you have to pay certain things for it. And here's the 3 different ways that insurance companies collect money from you. One is called a premium. And so you're paying to have that insurance available. Now, you're paying that money to have that insurance coverage regardless of whether you ever use the insurance. So for health insurance, you're going to pay that premium even if you don't go to the doctor once, right? And so the premium is collected, if you're working for a company, typically deducted from your paycheck. Every paycheck you get, a certain amount goes towards your insurance coverage, health insurance coverage. If you're self-employed, premiums typically get paid monthly. They collect them monthly. Okay, so that's one. That's clear, right? What a premium is. Okay. So the next part of your share of payment is called a deductible. The deductible is the amount of the health insurance cost that is your responsibility to pay. And it typically say the first $500 or the first $1,000, or it's some number like that. If you have a high deductible plan, it could be the first $5,000, but it's the first dollar amount. And it's not say it's $500 as a deductible. It's not $500. The first $500 is yours for every visit or every need that you have. It's the first $500 of expenses during the year. So that's on you. And insurance won't pay anything until you have paid the first $500 of bills altogether as the year progresses. We okay with what a deductible is?
Yeah.
Okay, all right. And then the third item, and one person said, yeah, and I'm kind of taking it for the whole class, typical. But if you don't understand, it's on you, right, to ask the question and interrupt. I don't mind. I really don't. And I'll try and explain it again or some other way or whatever. So deductible, reading it, is the amount that you must pay before the insurance comes into play. And it's the first, I'm using $500 as an example of medical expenses that you incur during the year. A co-payment now is once the $500 deductible is met, and you've come up with the $500, if that's the amount that your deductible is, and the insurance now kicks in, the insurance may only pay 80% of the cost, say, above the $500. You would be responsible for 20%. Fair? And that's called a copayment. Now, some insurance coverages provide 90%. You only have to come up with 10. Some 70, you got to come up with 30. But typically there's a copayment. Now, the other thing that's not listed here, I think that's later, but there may also, part of this copayment may, again, separate, and is every time you see a doctor, they may charge you $20, right? For just a visitation fee. That's another component. But so there we go. So young people, of course, we sorry, I can't call myself young anymore, but we consider ourselves invincible, right? Nothing's going to happen to us, right? But so I don't know. Here's the textbook saying 25%, 1 in 4 of young adults visit an emergency room every year. 1 in 4, which is, to me, a really high percentage. Again, I don't know how they figured the survey out or what the data behind it is. I think it's a much more reliable source than polls recently. So there must be a database that they're mining to get that information from, and that's real data. So it's surprising to me, but here it is, 1 in 4. 50% of young adults will visit a doctor 1 to 3 times a year, and 10% going to have more than 10 visits to a doctor or hospital during the year. 10, it's almost like 1 a month. So healthcare costs are a big part of a lot of people's lives, even young people. And what the government did is they stepped in 2010, and they passed the Affordable Care Act, which basically ensures that healthcare is available, has to be available for everybody with a minimum coverage amount. So again, insurance companies are there to make money, right? So in the past, you could have, say, you leave your job, and so you don't have that insurance coverage from your past employer anymore. You get a new job now. You got new insurance coverage. The new insurance may look at you. Wait a minute, you have whatever the disease is, pre-existing condition, and may say, I'm not going to cover you. So now it's mandated that they can't deny you, even though they may lose money on you. They may not be able to charge you enough premiums to cover the expenses associated with you. They'll try, but I mean, they cannot deny you. So that's a law that came into effect as recently as 10 years ago. And the other way the government comes in separately from private insurance company, other than mandating things to the private insurance companies, the government also provides coverage for those who are 65 or older, called Medicare. And then they provide coverage for people who are poor and don't have many assets to their name. They may have a car, but they don't have more than, say, a couple $1,000 in a checking account. And they're as long as their assets are limited, they're eligible to something called Medicaid, which in California is called Medi-Cal. And Medi-Cal coverage is amazing. It covers pretty much everything. So they cover the poor, right? Make sure the least of us, financially speaking, are not left unprotected from a health insurance point of view, and to cover the elderly with Medicare. And then the rest of us were covered by the insurance companies being, well, we got to pay for it, right? But the insurance companies have to provide us with coverage as long as the Affordable Care Act, I guess, is in place. Or any questions on that? Okay, so again, let's cover this. We talked about the premium that you pay in order to have the health insurance coverage. We talked about the deductible. The first $500 is on you. We talked about co-insurance, which is, after the deductible is met, the insurance coverage may only cover 80% of the expenses beyond $500, and you still have to be responsible for 20%. And here's the co-payment, that $20 per doctor's visit that you got to pay. So those are the ways that you have to pay. So let's get an example, which I thought was pretty good in the textbook. So Jane, what is it? Let me reduce this thing. Sorry, so I can read it. Bear with me. Jane breaks her leg somewhere. So Jane's health insurance is a $500 deductible. So it's the same as the example I used. And somewhere here she pays, she breaks her leg. Oh, there it is. If Jane's total bill for her, arm, not her leg, and the surgery, the total bill is $14,800. Here is what her share of the $14,800 is and how it's calculated. So sorry to move up the screen, but there it is. Can you guys see that? $14,800?
Yes.
Okay.
Yeah.
Thank you. So out of this $14,800, first of all, she's got to pay the $500 deductible. So that leaves $14,300, right? 14,800 minus 500 leaves 14,300. And her insurance company pays 80%. So she's got to pay 20%. So 20% or 0.2, right, times 14,300 is 2,860. Again, it's not 20% of the whole 14,800. First, you have to pay the first 500. Of the remaining 14,300, you got to pay 20% of it, which is 2,860. So when added together, 500 and 2,860, she has to pay 3,360. Now that's a lot, but better than having to pay 14,800, right? So let me share a little bit about this. My dad, when he first came to this country, at age 70, you know, he came after the couple of years after the revolution in Iran, where the Shah was deposed and the Islamic Republic of Iran became the government, and he left. He came to the U.S. He didn't have any insurance coming here, and shortly after arriving here, he had a heart attack. And so in Fresno, so he was rushed to Fresno Community Hospital downtown, and you know, they saved his life. They because of the work that they did, and through God's mercy, I had my dad for another year. I just had a gift of a year with him, and which you can't put any money into it. But I mean, the price of that hospital visit, that the surgery, the ICU that followed, blah blah, I think was like $150,000. Now, if you had insurance, forget this 20% that you got to pay or whatever. The whole bill would not have been 150,000. So let me explain that. So when an insurance company, you know, it has all of these people who are paying premiums to this insurance company to get health insurance. So it has this customer base, for lack of a better term. And the insurance company goes to the hospital and say, hey, if I allow these customers to use your services, we got to negotiate price. And so because they have this, you know, all of these potential customers to the hospital, and the hospital doesn't want to say, nah, I don't want to deal with all these thousands of people that, you know, the hospital's there to make money too. The hospital will concede and will lower the price for the services that they offer to below what these services cost to private payers. So when you have insurance, you basically have somebody who is bargaining on your behalf and is able to negotiate a lower price for the services that the hospital would otherwise pay. And it's not a 10% deduction. Let me tell you, it's huge. I mean, sometimes the insurance companies pay, I'm not making this, I'm not in all cases, but sometimes they pay 30% of what a private pay insurer pays. Not in all instances, but again, I'm sorry to repeat myself. But so if my dad had insurance, the whole cost of that service may have cost him 50 grand, right? And he'd be responsible. I mean, even if he had to pay all of it versus 20% above the deductible, 50 grand instead of 150 grand. I mean, it's impactful. So it's really, I think, important. I mean, even if you're as healthy as an ox, I mean, and when you're young, health insurance premiums, they don't cost that much, right? Because you're less likely to, you know, to get ill or, but I mean, again, 25%, who knows, that's statistics. But do you see it? Does that make sense? I mean, you get a bargaining giant in your corner who'll negotiate the price down should anything happen, and then will pay the bulk of that expense. So financially, that is a, you know, a big shield that you are purchasing. Questions? We good? Can I move on?
Yeah.
Okay.
Yes,
thank-
sir.
What was that? I'm sorry. That's what?
No, I said yes.
Okay. No, thank you. Appreciate that. All right. So here's a little illustration. There are all kinds of health insurance plans out there, right? There is fee-for-service plans, managed care plans, there's COBRA, there's hybrids, some mixture, and there's consumer-driven plans. So I don't know about these labels, right? But let's go over them. Maybe it'll make more sense as we tackle them one by one. So the first one is, I don't know what, oops, sorry. What happened? I've already did that part, so I must. First one is pay for service. Let me get to it. Apologize. There we go. Go down too low. Here we go. So a fee for service plan. An example of that is a preferred provider organization or a PPO. And I don't know, that just makes me laugh every time I say PPO, just schoolboy humor. But yeah, preferred provider organization. And that is the most flexible one in terms of you're paying for this insurance and you can basically choose your doctor and choose what hospital you want to go to. You know, if you need a hospital, what expert you want to see, if you need a specialist, without getting prior permission. Now, the premiums you got to pay in order to have a PPO or a fee-for-service plan is higher than you would for other insurance options. But again, you're getting the greater flexibility of which doctor to go to, which, and then et cetera, which hospital, which specialist. So that's one. We okay with that?
Yep.
So, yeah, all right. Let me move on. Next one is managed care plan. And a managed care plan, another better known, I guess, name for that, is an HMO or health maintenance organization. And what is a really well-known HMO here in Fresno? They even have their own hospital, hint, hint.
Kaiser?
Kaiser, yeah, Kaiser is an HMO. So Kaiser or the HMO provides their services through their approved physicians. So if you got an issue, you need to go see a Kaiser doctor. You can't just see any doctor. Fair? And then, and chances are, you have to pay a lower premium because you're accepting that restriction than you would under a PPO plan. Now, Kaiser's doctors are excellent and their hospital is excellent. I mean, I don't think your care is going to be compromised, you know, because you have this. But again, I'm just saying your choice is, you don't have it. The choice is limited when you take this, right? And if you want to go see a specialist, it's your primary Kaiser physician list to say, yeah, you need to see a specialist. You need to get approval first before you're able to visit the person you think you need. The doctor has to agree with you that you need to see that specialist. So any questions on that? I think that's a good distinction between PPO versus an HMO.
Yeah, that was good.
Thank you. Thank you. So the other one is, main one is, again, I don't know about these labels, but they call it a consumer-driven plan, but really maybe better known is a high deductible health plan. This is something I have, right? So the first, in my case, for a high deductible health plan, My deductible is not 500 bucks. My deductible is $5,000. So the first $5,000 of expenses per year is on me. And then my health insurance pays for 80% of anything north of 5,000. I'm responsible for 20% of it. And in return for taking that financial risk, for being willing to pay for the first $5,000 versus for the first 500, that lowers my premiums significantly. Relative, and this is a PPO. I can choose my physician. Are you with me? But it's a high deductible PPO. And so this is called consumer driven. I don't know why it's given that label. I honestly don't. So here's something that does make paying the $5,000 a little easier. Your employer that offers this high deductible health plan, say, will also, in conjunction with this health plan, offer you what's called a health savings account, or an HSA. And so if you elect to utilize and open up an HSA account, a health savings account, a certain amount of money, whatever you elect to put in, gets deducted out of every paycheck, and it gets put into this health savings account before tax. So it reduces your taxable income. So the government is basically subsidizing, depending on what your incremental tax bracket is, your part of your deductible. Does that make sense? So if you're in a 35% tax bracket, I'm putting, oops, now I'm using numbers, and hold on, let me open up Excel so I can do the math. Taking a while because I can't do it in my head. And it's kind of funny. Excel is opening and it says Microsoft Office Professional has woken up. Okay. Good morning, Microsoft. And of course, it's taking a while. But anyway, let me do it this way. If my deductible, 5,000 bucks, but I'm taking it before tax, I'm really only paying, and I'm in the 40% tax bracket, I'm only paying $3,000 after tax. I just did that in my head, sorry, right? So normally that 5,000, 2,000 of it would go to Uncle Sam if I'm in the 40% tax bracket, and I'm left with $3,000. But instead of, but because they don't take the 40% out, that $2,000, the whole 5,000 that I earned before tax can go into it, and if I can use that money that I put aside to cover medical expenses like the deductible, whatever expenses I would have to pay a deductible, any out-of-pocket expenses, whether it is for medication or the doctor visit. And can you believe it? It took this long for Excel to load. So, but I already did the math. So, so we good. Did that make sense? The before tax? Sorry, I was distracted with the Excel thing. Did I lose you?
Can you repeat?
Yeah, let me repeat it. Yeah, sorry about that. So this health savings account, I can put money into it, and the money that I put into it, I put in on a pre-tax basis. So it lowers my taxable income. And therefore, if I'm putting in $400 a month, 4,800 bucks a year, say, my taxable income gets reduced by 4,800, and I don't pay taxes on that $4,800 worth of income that I made. And the whole 4,800 over the year ends up in the savings account unless I use it. Now, I can use that money to pay for any qualified medical expenses. You can see that written here. And then if I don't use up the whole 5,000, say, right, it stays in that account. It rolls over next year. So it basically becomes a savings account, an extra savings account for me. on a pre-tax basis that I can set up in order to cover the expenses that, should I need to, that I'm responsible for under a high deductible plan. Is that better?
Yes, thank you.
Welcome. Yeah. Hard to chew gum and go downstairs at the same time. So trying that Excel thing kind of threw me. Okay. So that's called a health savings account. Okay. Now that is different than another account that you can open up, and I'll come back to Cobra in a moment, which is below here. And that is called, come on, Taraj. I always forget the name. It's not a health savings account. It's a flexible spending account. There we go. So flexible spending accounts, again, it's an account that you can put money in, and you can put money on it on a pre-tax basis, just like a health savings account. But the difference, big difference, is with a flexible spending account, if you don't use that money this year, in the year that you put it in, you lose it. It's use it or lose it. Now, why would you do that if you have the ability to open up a health savings account, say, and never lose it, right? Just if you don't use it, it just builds. Next year, you'll have more, right? And the reason is, with a flexible spending account, let's say you put in, I'm making this up, $100 a month. So you're going to have, assuming you stay employed, $1,200 over the year, 100 times 12. And you need the $1,200 after 1 month because something, God forbid, happened to you. It's available to you. So even though you haven't put it in yet, because you're contracted to put it in, it's going to come out of your paycheck. The employer will, you know, pay the medical bills, the $1,200 worth of bills, eligible bills, and then you kind of reimburse it. Does that make sense? As the year goes on. Now, if you lose your job, of course, now you owe the money back. Are you with me? That you used but hadn't yet paid for. As long as you have the job, they'll let you have the money before you put it in. Whereas with a health savings account, what you can take out is limited to what you put in. So if I have a $5,000 deductible and I only put in $400 and I have this need for $5,000, well, guess what? I can only take out $400. The rest of it is going to come from my other savings account or credit card or some other way. Does that make sense? So important for you to know the difference between an FSA, flexible spending account, and an HSA, a health savings account. Are we good with that?
Yeah.
Okay. So let me tell you a little bit about Cobra. Cobra, which I skipped, is if you lose your job, say, Cobra is another one of those government acts that forces the insurance company that you were with under your old employer to continue to provide coverage for you. Of course, you got to continue to pay premiums. Now here's the deal with Cobra. Because you are no longer employed by that employer, you don't get the employer subsidies that maybe you were getting before. You may not even were aware of it. So now under Cobra, yeah, you can continue to have that health insurance coverage that you had before, but chances are it's going to be at a higher cost than what you paid for when you were employed by your employer. And so this is coverage when you've lost your job and before you find another job. Does that make sense? Now, the max this will go on to typically is 18 months. I guess this says it may go on for 36, but I don't know what it takes to go on for 36. The ones that I'm aware of coverage is good for 18 months. If you don't have another job within 18 months, then you don't have COBRA coverage. You can still apply for coverage on another basis, just, you know, as a private pay citizen, right? But your premiums may be even higher than the COBRA coverage premiums, or they may be less. I mean, again, it pays to shop. When I left Wells Fargo, you know, they gave me a severance package, and it was a nice severance package. I mean, I'd only worked there for 2 years, and I'd met my goals, so they weren't firing me. But I mean, they were downsizing, right? The crash, so to speak, had happened. The market had dropped by almost 50%, and so they weren't making as much money as they did. They were trying to downsize, and you know, I was the last in, first out, and I wasn't the highest performer in the unit. So, but I met my goal, so they gave me a nice severance package. And part of that severance package was I had COBRA coverage, and I looked at the premiums, was kind of stunned. I said, what the heck? I've got to pay so much for health insurance. And then I looked around, see what other providers there were, and I actually found a health insurance coverage that was cheaper than the COBRA one that was offered by my employer, right? As it happened. But it's kind of nice to have that as an option, right? And it's a ready-made option available to you. You don't have to shop or knock on doors to have that available, right? And it's always good to have choices. So there's a choice you can have. Questions on that?
Aren't there actual business models that make it their business to comparison shop insurance plans? Isn't that like a whole nother business model now?
That's a great question, Ingrid. I'm not personally aware of, you know, that's a great question. So insurance brokers in general, I mean, and you want an independent insurance broker, meaning you don't want a captive insurance broker, somebody who works for, say, State Farm or Farmers or AAA, or, you know, but if you have an independent insurance agent, they can shop around and find out from a variety of different insurance companies the different kind of coverages that are available to you, and let you be aware of them. And you know, if you go with one of their recommendations, you know, they get you don't have to pay separately. They just, part of the premiums that you pay go to them. Does that make sense, to that insurance broker? That's how they get paid.
Yeah. I just wanted to ask because I thought that was kind of interesting. So thank you.
Yeah. No, you're welcome. You're welcome. Now, outside of an insurance broker, if there is a business model, so to speak, made where it'll help you make your choices, I'm not aware of that. I'm not aware of that. Not to say that doesn't exist. Great question. Again, this is not my area of expertise, right? I mean, I know just enough to talk about the subjects here in the chapter. And I did at one point have an insurance license, life insurance license, when I was working with Wells Fargo. But it's not something that I actively went out and try and sell. I just passed the exam for what it's worth, and therefore got the license. By the way, the exam is easy, but you got to go to this day-long lecture. And if you think, oh my God, I mean, it was, sorry, don't, it was awful. In my case, I was like, oh, it was like the most boring thing you had to sit through that I'd ever had to do in all my life. It was like, oh. So, you know, I was doing everything, reading stuff, doing everything except listening to the lecture. It was like crazy boring. But, you know, they give you a little manual, just read the manual. The exam, you know, is on the manual. You're going to be fine. It's real easy. Oops, I don't know what I'm doing. Sorry, I went up again. Okay. Disability. Did I miss life insurance or? No, health and then disability. Good. All right. So health insurance is one thing, but let's say you have an accident again, and you know, after you've been treated for it, it now changes what it impacts what you're able to do. You know, you may not be able to do the job that you had prior to the accident. And that is one of the possible definitions of disability is you cannot, one definition is you cannot do the work that you did before the accident. And if you can't do any job, then that's one kind of disability. But if you can't do your old job, but you can do some other job, that's another kind of disability. So you can get disability insurance to cover that event. Again, do you see the difference between that kind of coverage and covering your health costs, right? Your hospital bills, your doctor visits. This is, you can't do the job anymore. And so if you have, if you can't do any job, then that, you know, that complete type of disability, then, you know, you're eligible for state disability insurance, which, you know, is part of your coverage, and any kind of disability insurance that you bought outside of that also covers you. But a lot of insurance companies have a less restrictive definition. It just says you can't do your own job. So if you're a surgeon, say, and you have an accident where, you know, you lose the use of your hands, well, you can't be a surgeon anymore, but you could be a teacher. You can have another occupation, right? And so it's not like you can't do anything. You just can't do what you did. And that kind of more limited disability, you can't do what you did, but you can do something else. That is also covered under certain disability insurance programs. And so if you're eligible for that disability insurance, you get a percentage of your salary, say 40, 50, 60% of what you made for until you die, or until you get to a certain age, maybe 65. Again, depending on the type of insurance that you buy. So disability insurance, when you're young and you're working for an employer, is ridiculously cheap. I mean, it's like $10 a paycheck or some stupid thing like that. And again, I highly recommend you to get it. Now, if you're not totally disabled, right, you just can't do your job, but you can do another job, state disability ain't gonna pay nothing. And that was bad English, right? You're not gonna be able to benefit from disability insurance that you are paying for and that you have as part of your state provided insurance in California. You have to be completely disabled to get any of that. So, you know, who wants that, right? I mean, who wants any kind of disability? But that was a stupid thing to say, who wants that? But any questions on that? Nothing? All right. So again, under Social Security, state disability insurance, you would not qualify as disabled because you could adjust your skills to do something else, such as being a teacher or an instructor, right? If you can't, of course, I hate that. You know, there's the old thing, if you can't do, then teach. Yeah, not good. So, but in this particular case is actually an example of that. So here's an interesting table. different ages, age in 5-year increments, age 20, 25, 30, 35, 40. And what's the probability of you dying, right, at these ages? And what's the probability of you becoming disabled, right? And as you can see, no matter what your age is, the probability of you being disabled is far higher, double, right, almost, whatever, than the probability of you dying. So again, disability insurance, when you're working for an employer, is dirt cheap, in my mind. And just pay it, do it, have that coverage. Don't rely on Social Security or state disability insurance, because you have to be totally disabled to get anything. Get yourself that private insurance that covers more. Questions? Is this interesting to you guys?
Yes, it is.
Thank you. Glad. Let's go a little bit further down. Oh, yeah. Of course, nothing's easy, right? So with disability insurance, there are all kinds of variations, right? There are short-term disability policies, and these mean, you can't do the job that you did, but it's not forever, right? You go to physical therapy, you can rehabilitate, and say within a year, you're back in the saddle, you can do the job, right? And so short-term disability will replace some of your income, 40, 50, 60%, for say up to a year. That's what that is for. Long-term disability actually doesn't kick in immediately. You got to, get diagnosed. It's got to be determined that, not likely that you're going to be back to your previous normal. There's now a new normal. And that one kicks in after 6 months, sometimes 12 months. Then the 40, 50, 60% of your salary kicks in. Are you with me? So there's a short-term disability policy and there's a long-term disability policy. Just make sure you understand that. Now, here's the other thing. Again, there are riders that you can get. There we go. There are additional features that you can get when you buy disability insurance. So one rider is what's called a cost of living adjustment, or COLA, which again, let's say the disability pays your salary, say 60% of it, right? A cost of living adjustment increases that by some kind of measure of inflation or the consumer price index. So it pays you the 60%, but then next year that 60% goes up by 2% of the 60%. Does that make sense? To cover insurance, or what? Inflation. Another kind of rider that you can have, which is this kind of an interesting thing. One of my coworkers at Wells Fargo would do this. He would sell a disability insurance coverage, and what it would have is the money that you put into that, the premiums that you pay to have that coverage would build up in a savings account. And if you die and you never filed a claim for disability, you never utilized it, your heirs actually get those premiums that you put in back, or they get those, gets refunded. But there's no interest or earnings on those premiums that you put in. The insurance company keeps the money that they made on your money. Does that make sense? But you get your actual premiums back. Now, this was provided, this was offered to clients who were older, who were self-employed, business owners or whatever, and where the cost of disability insurance was pretty high, right? So to convince these clients or to, hey, so one of the things you convince is some disability insurance, the result is so severe, you got to be in a home, and have people, watch you, 24/7, right? Have nurses in place and be connected to things and special beds, have people give you a bath. I mean, feed you, blah, blah, blah. And some of these homes that provide this kind of service, I mean, the cost of that is depending 8, 9, 10, 11, 12, 15,000 a month, right? Now, it's money, real money. And so, to convince somebody to put aside, say, $5,000 a month to cover that benefit, cover that coverage, then one of the features that the return of premium had is, hey, I know you're putting $5,000 a month aside or whatever it is, $2,000 a month aside, whatever it is you're putting aside, but you're really not losing it. If you die, your kids or whoever your beneficiary is will get that. Another rider or tweak that you can get on your disability insurance policy is called a partial disability rider. Let's say you could do your job, but you can't do it full time anymore. You can only do it part time. Okay. So let's say you can only work, I'm making this up, 20 hours a week or, 8 hours a week, whatever. Let's say 20 hours, half time. Then you still earn half your salary, I guess. And then the disability pays 60% of the half that you don't earn anymore. And then the other part is some of these insurance policies have a waiver of premium, meaning once you get disabled, then after a period of time, you don't have to pay the premium anymore, right, to get the coverage. They'll actually waive it. What do you guys think? There's a lot here. I was kind of like fire hose, gave you a lot of information, but it's all right here in the chapter, right? So you can review it whenever you need. Let's talk about another kind of, yeah, go ahead.
Oh, sorry. I just wanted to ask, this is like a really specific question, but for that specific kind of plan where the paid premiums would be basically inherited to your heirs if you died before you were able to put a claim on it.
Yeah.
Sorry, I'm trying to phrase it. Do you have any idea how that would be influenced with California's inheritance laws?
Oh,
have really
yeah, good question. Good question. So, so short answer is I don't know. So that's a good question, but so I don't, so there are two ways it can go, right? I think because in this particular case, I'm speculating, but I think I'm right, because you have to designate who the beneficiary of your policy is, right? Is not something that's going to be determined by court, right? I mean, you designate it's in your policy. Assuming you designated it's your policy, then it is not part of your estate and therefore does not get taxed. My opinion, again, actually don't trust me, but I think I'm right. But I mean, double check it with whoever the insurance person is that is providing you this. But my opinion is, to the extent you have a beneficiary, it's kind of like and we'll go into this later, if you have life insurance and when you die, if you have a beneficiary, the beneficiary gets the life insurance proceeds tax-free. It's not part of your estate.
Oh, okay, thank you.
Does that make sense?
That's kind of like, that's just, you'd think that would be generally protected under a policy.
Yeah.
Because, okay, all right, thank you.
But Again,
Double check.
double check. Yes, please.
I don't anticipating needing this for a while, but
Yeah,
I
no,
just
but
thought it
yeah,
was
I'm just saying, I'm not,
really
this is
concept.
not my area of expertise, right? Are
Yeah.
you with me? I know enough to be dangerous, but yeah, double check. But I believe what I said is true, but that doesn't necessarily make it true.
Thank you.
Yeah, you're welcome. Good question. Great question. So workers' comp is another form of disability. Now, workers' comp kicks in if you get injured on the job as a result of doing your job. And, you know, that is covered. Your employer pays for workman's comp insurance, and that's part of your payroll insurance that you pay for. And you don't have to get separate disability insurance for that to kick in. Are you with me? But though I would again strongly recommend that you get the separate disability insurance when you're employed by an employer, because it's just dirt cheap. $10, just not even, it's not even a question. Do it. So, so workers' compensation only pays benefits if you are hurt on the job. And you must prove without a doubt that your disability was a function of your job. Guess what? The insurance company will fight that claim. They don't want to pay the premiums, right? So you got to be able to prove it. And you know, there are workman's comp attorneys that will take your case, and you know, unfortunately, now some cases are clear cut, right? But other cases may not be that clear cut. We good? Can we move on to life insurance?
Yes, sir.
Awesome, awesome. All right, so life insurance has three components. There's the owner of the policy, the person who's making the premium. So let's say you're buying life insurance on yourself, you own that policy. But I guess usually the owner of the policy is also the person who's insured. But not necessarily. Yeah, that's a good point. Hold on, let me think about this. That's a good point. So let me get back to that. And then there's the beneficiary, the person who gets the money when you die. So one thing about life insurance is you do not get the benefit of it. You're dead. You're done. The person who gets the benefit of it is whoever you choose to be your beneficiary. So here's the deal about life insurance. You don't benefit from it. Why should you get it? Why should you buy it? And here's some of the things to think about. If there are people who are dependent on you, spouse, children, parents, and you are the one of the main financial engines that makes it possible for them to have a roof over their head, you know, a meal, a regular meal, and you know, basic comforts, then when you die, your earnings ability is gone, obviously. So what are your loved ones going to do when they don't have you and they're currently depending on you? Well, then life insurance comes in. And you need enough life insurance to make sure that the needs that your loved ones have are covered. So that could be, I don't know, if you got kids, you may want to have enough life insurance in place to cover their college tuition, right? You know, and of course their growing up expenses. Enough life insurance in place to pay off your mortgage to make it easier on your wife or spouse, right? Who again doesn't have you anymore. So now some people say, you know, rule of thumb, just get 10 times your annual salary. And I guess they're saying, you know, if you're making $50,000 a year and you get $500,000 of life insurance, well, hopefully you can earn 10% on that $500,000. There's your 50,000 a year, I guess, maybe. But that's certainly one way to do it. Get a multiple of your annual income. But I think it wouldn't hurt you to also think through what your loved one, what your kids, will actually need. And they need to pay for A and B and C and D. What does that sum up with? How much is that a month, say, right? And then you use your calculators. What they need on a monthly basis is the payment. How long do they need it for is N, how many periods you need it for. The return that you think that you can get on a pot of money is I, right? And that return divided by 12, right? And then when they don't need it, they don't need it anymore. The future value is 0. So calculate PV. There's your life insurance. Did I go too fast? Did that make sense?
Yes.
Okay. Cool. So you can certainly do it again as a rule of thumb, multiply by 10, multiply by 5, whatever you want. But it's, in my opinion, you got the skill set. I showed you how to use the calculator. Figure it out, right? Think about it. And that's how much life insurance you need. Now, I had a customer at Wells Fargo who refused to buy life insurance. He said, what do I care, Taraj? I'm dead. I'm not going to care anymore. And they're on their own. That's on them. And I thought, I guess I actually heard it. This was an actual comment. And I thought about it as it was some kind of spouse or father you are, but I didn't obviously say that to him. I just was more deer in the headlights at that kind of attitude. It was weird to me, but some people have that. So again, life insurance benefits the ones that you love. Okay, so oops. So there's this graph, or not graph, whatever, picture. And so here's the life insurance company, and you are the owner and you're the one who's insured, and you pay the premiums, and you choose who the beneficiary is, your wife, your kids, your parents, whoever. And then if you die, the insurance company pays your beneficiary. And say you got a $500,000 life insurance policy, I just made that up. That $500,000 goes to your beneficiary tax-free. They don't have to pay taxes on those proceeds. Now, the premiums that you pay to the insurance company to have that coverage are not tax deductible. So everything's outside of the tax blanket or umbrella or whatever. The premiums you pay are not tax deductible. The policy proceeds in turn are not taxable. Does that make sense? So now, remember, there was a difference, which I started laughing about, between the owner and the insured. So there are people who are out there who will, let's say you buy life insurance and you're the, again, you're the owner in the insurance. They will purchase the life insurance contract that you have from you. Now you're still the insured, but they become the owner. And what they will do is they'll change the beneficiary to themselves. Now it's to their benefit if you die. And, I'm just telling you, some people who buy these life insurance policies as an investment are not the most ethical people. And you may have an unfortunate car accident sooner than you think. Brakes won't work, or your house may burn down on you, whatever. Are you hearing me? Because there's somebody other than someone you love who now will benefit when you die. So I'm laughing. That's not really, obviously, sorry, not funny, but kind of is. Here's the other thing. So who's that radio talk show guy, older guy? I can see him, but my mind's going blank, and he now does some commercials for different products. Sorry, so I can't think of his name, and I can't mentally telecommute the picture of him that I see in my head. Larry,
Larry King.
Larry King, bless you, thank you, Larry King. So Larry King bought life insurance on himself, right? And then figure out he could sell it. So he'd buy life insurance, you know, qualify for life insurance, and he qualifies for a lot of life insurance, right? Because there's a lot of income that have to be replaced if he dies. And he sold the life insurance policy to one of these third-party purchasers and made a boatload of money, right? I mean, far more than the premiums. And he said, oh, this is pretty good. So then he did it again, bought some more life insurance on himself and sold it. And then he wanted to do again. And life insurance, his broker said, sorry, Larry, no can do. He says, what do you mean no can do? He says, well, you only have so much income generating ability, which makes you eligible for only so much insurance. Again, the insurance is there to replace your income or protect your finances. It's not there to make you rich. Are you with me? So there's a limit to how much life insurance you can purchase. And the amount of life insurance you have out there is public knowledge. I mean, the insurance companies have databases that tell them that. Are you with me? And so then he sued the broker. He said, well, you didn't tell me, because now I sold all my life insurance policies and I don't have any life insurance for my loved ones. I don't know. Sometimes I'm telling you, life is stranger than fiction. But there's another life insurance story for you. Any questions? Okay, moving on, right? Okay, after that story. So there is two basic types of life insurance. One's called term life insurance, and the other one, for lack of a better term, is cash value life insurance, and we'll go over those. So term life insurance is life insurance that you can cover that's good for a certain period of time, for a certain term. You can buy 1 year life insurance or 10-year life insurance or 30-year life insurance policy or more, right? And so one of the benefits of term life insurance is once you buy it, the premiums do not change for the life of the policy, 1 year life, 10-year life, 30-year life, depending on what you buy. All right. And the only thing you buy when you buy term life insurance is insurance. And again, as you know, as you get older, your life insurance costs go up. If, in other words, if you buy it at age 20 for 40 years, that's the lowest premiums you'll ever pay. Are you with me? But if you wait till you're age 30 or 35, your premiums will be higher. That's because you're closer to your time of death, because you're older. The other thing to be aware of, life insurance is not mandated by our government. So let's say you get some kind of terminal illness. I mean, I don't know, whatever, cancer, AIDS, some, you know, stupid thing. You may not be eligible for life insurance anymore. So life insurance is something you have to buy when you're healthy. Once you get seriously sick, it's basically too late. You, in some cases, can buy life insurance even when you have some illness, but the premiums are ridiculously high. They're really so high. Questions on that? So some of these term life insurance policies have something called a guaranteed renewable provision. In other words, you got a 10-year policy, and on the 8th year you get cancer, you can still renew your life insurance policy, but your premiums are going to be radically higher than they were before you got that illness. It says right here, where's my mouse? Guys, see it? Your premium will increase if you do renew, but at least you'll have coverage. See it? And the idea of having life insurance only for a certain amount of time, partly is, hey, you know, once my kids are through college, then they don't need me anymore. I don't need life insurance to help them anymore because they're on their own, say. Okay. Questions on that? Sorry if I talk too fast. You guys doing okay?
Yeah.
Yeah.
Okay, thank you. All right, so the next type of, big category, life insurance is called cash value life insurance. And cash value life insurance, when you buy that, and an example of that is whole life, you're not only buying life insurance, you're also setting up a savings account. It is both an insurance vehicle and a savings vehicle. So consequently, your premiums are going to be, what you have to pay in order to have this life insurance coverage are going to be significantly more than they would be if you just had term insurance. Now, okay, so pros and cons. Let's say you buy cash value life insurance, your premiums are triple, easy, what it would be for your term life insurance, but that extra money that you're paying goes into a savings account. Not all of it, some of it pays for fees. And here comes the rub, so to speak. In certain of these life insurance policies, you either, and we'll go into those in more detail, the interest that you earn on your savings is less than what you would earn in the market, or if they even let, in some cases, they'll let you put that money in, mutual funds, right? But in addition to whatever the mutual fund fees are based on what they are willing to offer you, the life insurance company also has their fees on top. So there are just more expenses associated with this savings program than you would have on your own if you went on it on your own outside of the life insurance deal. So Dave Ramsey, for instance, is death on cash value life insurance. He says, listen, just get term life insurance that gives you the insurance. That's what you're buying. You absolutely have to have a savings program, but do that independent of the life insurance company, right? Set up your own. Now, and I understand that, I respect that, but let me give you the other side of that story. First of all, when you buy this cash value life insurance, you do not have a choice. If you want to have that life insurance coverage, you got to continue paying those premiums, right? So you have to pay the premiums. Whereas if you're on a savings program, it's your own self-discipline that makes sure the premiums get paid. And there's always temptations, house needs a new water heater. I just installed one yesterday. My car needs that, or, I really want that new iPhone, or I really want that watch, or I want blah, blah, blah. There's always reasons to spend money versus to save it, right? And if you don't put the money in your savings account, you don't. It's your choice. So if you don't have the self-discipline, the cash value life insurance is because, again, you don't have a choice. You have to make those premiums every month. I'm just letting you know, that's, some people could see that as a disadvantage and some people could see that as an advantage, right? No, I have to pay it. So there we go. Manage the other expenses with what's left of my cash flow and my savings. The other benefit to this is, as you're putting money aside into this cash value savings account, again, we'll go through the differences later on, the money that you earn on your money grows on a tax-deferred basis. You don't have to pay taxes on it. So it's kind of like putting money into a Roth IRA, right? Your investment in the Roth IRA is not deductible, but whatever you put in the Roth IRA grows tax-deferred, possibly tax-free. Agreed? So Roth IRA, the maximum you can put in right now is $5,000, right? And the maximum that I can put in a 401k is $19,500. And because I'm over age 50, they let me put in an extra $6,500. So I can actually put in $26,000 a year in my 401k. Now, if you're making a boatload of money, you know, 19,000 may be chump change, and you may want to put more money aside that'll grow without the income on it being taxed. So it'll grow on a tax deferred basis. Well, then cash value life insurance are the vehicle for you. So Dave Ramsey primarily speaks to people who are, you know, living paycheck to paycheck, you know, aren't making that much money, right? Need help with their budgets, need help with putting some financial structure in place in their life, which is great, right? But if you're, you know, if you're part of the rich, what can I say, right? And lots of income, there are a lot of benefits to having cash value life insurance policies in place. Any questions on that? Did that make sense?
Yes, it is.
Okay, cool. Again, if it doesn't, let me know. Want me to explain something again? Please let me know. So here are the different types of cash value life insurance policies. First one, I don't know why it doesn't scroll down when I click. Oh, there it is. The first one's called whole life insurance. And the extra money that you're putting in that savings account just earns a fixed guaranteed rate of return. Again, it's not high, it's low, right? Then there's universal life insurance, which pays you a higher return than whole life insurance on the cash value portion of your policy, but not necessarily higher every year. It's not a guaranteed rate of return every year. It changes from year to year, right? Depending on market rates. Now, here's the deal, which is kind of cool. Let me explain this a little more. Let me read it. You also get the ability to skip premiums in the future and to adjust the face value of the policy. Let me explain that. So you're putting money aside in this, you know, quote unquote, savings account within your life insurance policy, and it's earning interest, it's growing. And say after a period of time, you got, I'm making this up, $15,000, $20,000 in it, again, making that up. And then your premium is $1,000 a year, say, and, or $100 or something a month, or whatever it is you're paying. Now you got 15 grand. If the 15,000 is making $1,000 a year, you can use what that 15,000 is earning to pay for your premium. Now that 15,000, the amount that you're earning, of course, doesn't add to your 15 grand. It goes to pay your premium. Or if you're not even earning that much, you got 15 grand, you can use that cash value, as long as you have it, to pay for your premiums. So there is that opportunity to use the money that you saved up to continue to have that life insurance in place without continuing to pay premiums, at least for a period of time. Once your cash value that you built up is used up, then you need to pay the premiums or you lose the coverage. Did that make sense? I'm assuming it did, okay? Because you're not asking questions. So let me go on. Now, variable life insurance, the third one, again, you have a savings account, but actually this one gives you the opportunity to put your savings money in, instead of getting a fixed interest rate of return or an interest rate of return, you can actually put it in a mutual fund, put it in play in the stock market. You can get higher returns, but you can obviously lose money too, right? But it just gives you that option. And variable universal life, you know, again, some kind of combo allows you to invest in more risky investment products, you know, mutual funds, and then retain the ability to skip the future premiums, assuming you have enough cash balance built up to pay for your premiums, right? Okay. So life insurance. If you're a male, you have to pay more higher premium than if you're a female to have the same amount of life insurance, because we men, we die earlier and we do more stupid stuff than females do as a rule, I guess. And then if you're a smoker, holy moly, your insurance premiums are going to be much higher, smoker or a drug user, than if you were a non-smoker or a non-drug user. Just be aware of that. Big, 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 big difference between smoker premiums and non-smoker premiums. Now, also, as you get older, your life insurance premiums go higher. And then if you're a bad driver, you get speeding tickets. And then, you know, again, that's public record, right? Life insurance will check that. And if they see, ooh, speeding tickets, they'll charge you higher premiums because you're not a safe driver. And if you participate in some risky activities like skydiving or being a race car driver, or in this case, or pilot or a scuba diver, these kind of risky activities, they may refuse to cover you. That's too risky for me. Or at the very least, they'll charge you more to have the life insurance policy. Now, again, let's say, I know you guys are not thinking that, this is just your weird instructor, but let's say you want to lie on your life insurance application, right? But, and you happen to die because of one of these activities, right? The risky stuff you're involved in, or the smoking, or blah, 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 right? And if the life insurance found out, right, hey, wait a minute, this guy died from skydiving, that wasn't listed in the application. How long has he been doing that for? And anyway, if they find out that you lied, your life insurance is void. And the most that they will do is give your beneficiary a return of premiums, maybe. You with me? So just be aware of this stuff. Now, this thing, I'm sorry, I got another story for you guys. So a friend of mine, a coworker of mine, about, I think it was 3 Sundays ago, if I'm not mistaken, time flies, went up to Yosemite with a friend of hers. And they're walking down this path, you know, towards, you know, Big Dome, whatever the thing's called. And anyway, and they're walking up that path, and she tells me that 20, 25 feet in front of her on the path, this bear crosses the path, right? And she's telling me that this bear, again, it's on all fours and kind of ambling across, that the shoulder height of that bear was basically as high as her shoulders. It's a big bear. So, you know, she freezes in her tracks, and the bear doesn't see them, just keeps going. And her companion actually steps back. It's ready to run. And then after the bear disappears and they catch their breath, the companion kind of, okay, starts going forward again. And she says, oh, hell no. And she turns around and goes back to her car. And I can't blame her one bit. And, you know, I'm looking at this picture in your textbook of a guy. To me, that is like going into the ocean and seeing a great white shark just pass you by while you're in the ocean. Not do anything to you, but let me tell you, that would cure me. I wouldn't go in the ocean again. Done. And I'm seriously thinking, am I really? I mean, I'm not sure I want to go to Yosemite again, because, you know, listen, I think I can, you know, I've got this foolish notion that I think I can protect myself against a wolf or a dog. I mean, you know, my hands can keep that snout away, and, you know, maybe I can gouge its eyes or something, you know, something like that. But a bear? You know, those razor sharp claws, how would you stop that? I mean, one slash, you're done. You're decimated. So if I'm ever going to go on a trip to Yosemite, let me tell you what, I'm going to have a spear or something like that with me, just in case, you know. I mean, just the thought of that big bear going by, that freaked me out. So And life insurance policies, they don't ask you, do you take trips in Yosemite, right? So don't don't share this story too much because the actuarial people may add that to a risky activity. But I mean, I guess that's based on how many bear deaths occur, and they're not that many, so maybe it's not that big of a deal. But it was a big deal to me when she told me that story. So anyway, sorry to scare you if I scared you, but I just thought, wow, not something I expected to hear. Questions? Comments? How we doing?
Pretty good.
Pretty good. Ready for more? I'm going to do auto insurance next, okay? And then we'll do the homeowner stuff next time. We good with that?
Yep. Sounds
Yeah,
good.
sounds good.
Professor, I had a real quick question. Would it be
Yeah.
all right if I just wanted to double check the stock track report. Do we not have to worry about that for a while yet?
No, I need to upload it because we're, time flies, right? We get into the end of the semester. It's not due till the end of semester, but thank you for that reminder. I do have the report stuff recorded from a past class that I did. So I will upload that.
Okay, thank you.
Yeah, I need to do that and the amortization table. I will do both. Thanks for that reminder. We good? Any other questions? Again, if you have stuff in chat, because I'm looking at the web here, I don't see it, right? So feel free to interrupt me. In fact, let me stop sharing for just a brief second, just to make sure there's nothing in chat. No, we're good. Okay. Because I forgot one of our students doesn't have a mic, so can't call me. Okay. So, automobile insurance, really, again, I don't know how they come up with these names, a personal automobile policy or a PAP. Dude, it's automobile insurance, or whatever you want to call it, right? So automobile insurance, let me scroll down to, there it is, this table here. So these are the minimum auto insurance levels that are required by the state. And you got these three numbers, like in California, there's 15 and /30/5, fair? But every state's different. You see that here, the 50 states. Let's talk about California, because that's where we are in. And the first number is the maximum amount that, again, you got an auto policy is what are we talking about, right? Auto insurance. The first number is the maximum amount that the insurance company, I'm reading this, will pay in medical expenses for someone other than you or your family if you cause the accident, right? So you rear end somebody, you bump into somebody, right? And they get whiplash or, whatever, something that needs medical care and attention, physical therapy, maybe a surgery, who knows, right? The first number is the maximum amount that your insurance will pay to one individual who was injured. The next number, so for California, so I need to scroll up because, yeah. So the first number is 15,000. The next number, 30,000, is the total amount that the insurance company will pay for all medical expenses for everybody in the car that you hit, right? So it's 15 max per person, but there could be 3 people in the car, right? So the most that the insurance company will pay for the 3 is 30 grand. Are you with me? Right? Not 45, not 3 times 15. 15 max per person, 30 max overall. And then the final number, this, for California, the 5,000, is the maximum amount that the company will pay to repair somebody else's property that you damaged. So if you rear end a car, the max that they'll pay, to fix the car is $5,000. Anything over and above that, it's on you. So, I mean, just looking at the 5,000, I mean, it's better than nothing, right? But it really doesn't take a lot to rack up $5,000 in car repairs. And medical expenses can easily go through the roof, right? Would you agree? So you are street legal if you buy this minimum coverage, but you're really not protected. This is not enough to protect you. Do you see that?
Yeah.
So again, you need to have it just in order to be permitted to drive, but please, please, please get more. What I have is 100,000. The second number is 300,000 and the third number is 50. I'm not even sure if that's enough, but that's what I got. Now, on top of that, I bought an umbrella policy, and we'll talk about that later. But here's an interesting thing. If you look at the different policy limits, and like I said, every state is different. Let's say you're street legal in California, and I mean, you got this minimum, right? But you drive to Arizona. Wait, that requires this last number to be 10, and you only have 5. You may be street legal in California. You're not street legal in Arizona. Cop pulls you over, license, registration, insurance. You do not have adequate insurance. You see that? You're basically driving, well, I can't say uninsured, but you're underinsured. And you can be fined for that. Isn't that interesting?
Yeah, it is actually.
Right? So here's this example. You side, you cross the, I don't know, red light, or you don't see the stop sign. You sidewhack a Mercedes. Oh, okay, $50,000 worth of damage. And you got what, $5,000 or $10,000 worth of coverage. 45,000 is on you to pay. Yikes. So get more insurance. Do not get the minimum required by law. So here's some of the things which will decrease your premiums, right? Again, premium, just like with health insurance, that's the monthly amount that you pay in order to have auto insurance coverage. And you got to pay that whether you have an accident or not, right? Just to have the coverage. But if you have a good driving record, that'll decrease your premiums. Look at this. If you have a high credit score, that'll decrease your premiums. If you take and pass defensive driving courses, that'll decrease your premium. If you purchase your auto insurance with the same company that through which your home is insured, sometimes they have this bundling, and then you can save a little bit of money that way. Look at this, being a good student, getting good grades, having a good GPA, that can decrease your premiums. Here it is, being a male, your premium is going to be higher because we guys just, are worse drivers than you ladies. We just drive, we think we're better, but the insurance premiums prove that as a rule, we're not. We're more careless. We take more risks. We're more aggressive as drivers, right? Though sometimes, I look at some of the people that are driving on the street and I see ladies, putting on makeup while they're driving. And it's kind of like, really? And being on the phone. Listen, I've seen policemen be on the phone. That always weirds me out. So you're not supposed to do that. But but be that as it may, here it is. Being a male, you're going to pay more for car insurance coverage than if you are female. Being younger than 25 is also dings you because, you know, I guess what, your brain's not developed yet. I don't know what the heck, but again, you're at risk. You think you're invincible and you get impatient. And, you know, I want to get to that stop sign before the other person. Isn't that what happens? I mean, people kind of like change lanes, go there, and what happens? They stop at the next stoplight, and I get there, and it's kind of like, okay, you got to the stoplight ahead of me. Woot. Maybe you need to drive even faster. Wrong, but you with me? If you were in LA, again, more traffic, your car insurance premiums are more than if you're in Fresno. If you have an expensive car, your car insurance premiums are going to be more than if you don't have an expensive car. And if you do a lot of commuting, or if you're in sales, right, and you got to use your car to go to see customers and blah, blah, put a lot of miles on, again, that'll increase your premiums. Questions? Are we good?
Yes.
Okay. All right. We're almost getting there. So what we talked about primarily is having, like, you know, the minimum coverages, the free numbers there, liability coverage, you know, covering expenses when you're at fault, right? Now, if somebody else is at fault and they rear end you, then you're looking to their insurance company to pay for your damages, healthcare costs, whatever. Hopefully they have more than the minimum required by law. But if they're uninsured or underinsured, make sure that the car insurance policy that you have has a provision for that. So if it's not your fault, you get rear-ended, and the person that rear-ended you doesn't have enough insurance, that you want to be covered. So make sure your insurance covers you. Fair? And that's called uninsured coverage. Not that you're uninsured, but the person who hit you is uninsured. The other kind of coverage that, you know, if you got a car loan, they'll require you to have collision coverage or, you know, comprehensive coverage, meaning that if your car is hit, you got to have enough insurance on it so that the car can be completely fixed or replaced, because the car, the loan, the bank or whoever's lending you the money on your car loan, they want to make sure that when if the car is gone because of an accident, that they still get paid. Are you with me? So they are the beneficiary to your comprehensive coverage if your car gets damaged, and they will force you to have that. Now, in my case, because, well, whatever, you know, I still have a 1997 Honda, and I also have, sorry, a 2007 Lincoln, which I need to donate because the transmission went bad. But on both of those cars, I don't have any car debt. So, and on my new car, I don't have any car debt. So I don't have to have this coverage. Are you with me? It's kind of nice to choose, right? And certainly on the 1997, I don't, you know, the old car maybe is worth $500. Why would I spend $5,000 to fix it? Are you with me? So I don't want comprehensive. So again, you got that choice when you don't have that insurance. Now, comprehensive carries not just collision damage, but if you know, there's a break-in, guy breaks the windshield, tries to take the stereo, gets your laptop, whatever, or vandalism, that kind of covers it. But remember, you have a deductible. The deductible is in place not only for health insurance, it's also in place for car insurance. Now, typical deductible is $500, right? But let's say you have an emergency fund. Did we talk about that, right? Putting together an emergency fund. And you put money in, and remember, you know, the minimum you want is $500, right? Sell stuff on eBay, get the second job, do whatever you got to do to have that. But you keep putting money aside so you can cover possibly a loss of job. So you maybe have 3 months worth of salary there, net take home pay, just like we talked about. I don't want to revisit that. But if you have that money to cover the emergency, you could raise your deductible from $500 to $1,000, say. And because you're willing to take more responsibility for the expenses, right? Your first 1,000 is now on you instead of the first 500. Because your first 1,000 is on you, the premium that you got to pay to have the insurance coverage is less, and it's going to be significantly less. So let me ask you to do this. It's not really homework. This is on you, right? But, you know, ask your parents, or if you have car insurance coverage, ask your insurance guy, make sure you know what your deductible is. And if your deductible is $500 and you know what premium you're paying, or your parents know what premiums they're paying, how much would your deductible reduce to how much would your premium reduce to if you raised your deductible? Boy, did I butcher that. So if you raise your deductible from $500 to $1,000, how much lower does your monthly premium go? Question. Find out. And that's a way your emergency account, because again, that's not your investment account. That covers insurance. That covers emergencies. That is your self-insurance. That's how your emergency account actually pays for itself. You're not getting an interest return. You're getting this stupid 0.25% or 0.1% from the bank or whatever the heck you're not getting, right? But because you have that money aside, you can pay less for your car insurance because you're willing to accept more of that risk. Are you with me? And it may be worth it. Like, hey, I'll take $500 more risk, but if I can save, $400 a year on premiums, maybe that's worth it, right? That's a 1-year return on investment. Boom. And talking of premiums, just FYI, with car insurance, once the premium is paid, there's no 80-20 or 90-10. The car insurance company will pay whatever's expenses are incurred beyond your premium up to the maximum amount that you're insured for. Fair? So hopefully it's not 1535, right? Because then it doesn't really pay much at all. But if you got 100,000, 300,000, 50, the first 500 is yours, and the next 99,500 per person is the insurance company's. You don't pay 20%; they pay 100% of above your premium, above your deductible. Did that make sense?
Yes, it does.
Okay, cool. So a couple of things that you got to do. Let's say you are in a car accident, right? Obviously, somebody got injured, call 911. But here's the deal. Get the name, address, date of birth, telephone number, driver's license number, and the expiration date, and the insurance company name of whoever it is that you hit or hit you. A lot of data to get. Make a note of what kind of car you hit. Year, model, license plate number. If the driver that you hit or hit you doesn't own the car, hey, it's a student driving mom or dad's car, make sure to write down or take a picture of the car owner's information, which is in the car registration form. Take a picture of that. Really, you should have the name, addresses, etc. of all the passengers in the other car. They're going to ask you for yours. And then if there's a witness, oh, that would be so cool, who sticks around, get their name and phone number, because the person that hit you will say it was your fault, right? Even though they hit you, or may say that, because they don't want to be held liable, right? And so to have a witness will change the he said, she said thing into, hey, here's a witness that says this is what happened. So again, nowadays, if you got a smartphone, use your camera, take pictures, right, of the driver's license, take pictures of the license plate of the car, take pictures of the damage that was taken. Very, very, very important. Because you don't want to be responsible for damage caused by some other accident a year ago, right? Had nothing to do with you. Make a picture of the damage that you caused. So there's no doubt, or that they caused, whatever. You know what I mean. And file a police report. Very, very, very important. You can do that online. Now, if there is an injury, you wait till the policeman comes, you know what I'm saying, and all that kind of good stuff. But if no one's injured and you're ready to drive away, make sure you get all this information to the best of your ability from the other vehicle, the passengers, and witnesses. And then file a police report. Now, you also need to do is tell your insurance company that, hey, I had an accident, so that they're aware and can protect you. Remember, you got insurance to protect you. So let's now talk about what not to do. I don't know. This is according to the state of California. Never, and it says ever, volunteer information about who might be to blame for the accident, even if you suspect it was your fault. Call your insurance agent or company first before admitting to anything or agreeing to pay for damages. Do not sign anything at the scene of the accident other than a ticket from a law enforcement officer. Signing a ticket is not an indication of guilt. It just means that you agree to appeal in court or appear in court. Excuse me. Always report the accident to police, even if the other driver does not want to, because they may change their mind, right? They may go home and some friend will say, no, you need to do this. And then, hey, you can say it wasn't your fault, blah, 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 right? Just don't, I don't know. Not everyone's trustworthy, right? So sometimes just, it is what it is. And it can always be worse, right? So limit it to what it is, not to what somebody fabricates it to be. Questions? Okay, homeowner stuff, we're going to wait till next class. Again, 2 hours of me talking pretty much nonstop. Let me stop this share. Any questions for me?
Can you email us when you post the amortization video and the?
Yes, I will. I will. Will
Thank
you?
you.
Is there like a due date for like the book homework?
Well, yeah. I mean, just do it when you can. Definitely before the end of the semester. Are you with me?
Yeah.
We good? Pause recording.
Yeah.
Professor?